in 2026, women still earn less, invest less, take more career breaks, and retire with less on average compared to men. Financial education is one of the levers that can help to change this outcome. In this Know Your Numbers discussion, we will be empowering you with a financial wellness checklist, a practical tool to help you understand where to start and show you examples of the questions you need to start to ask to own your financial journey. We've divided this checklist into 4 bite-sized sections: Know, Protect, Grow, and Legacy. Elke, fantastic for you to join us. In this Know section, we have what feels like infinite needs and a very, very finite budget. How do you, as a certified financial planner, do the budgeting process with your clients? And is there such a thing as an ideal budget?
Martine, thank you. It's lovely to be here with you guys this year again. And I'm loving the theme of Know Your Numbers. I think when it comes to a budget and setting up the ideal financial portfolio, everything starts with the drawing board and how you plan your monthly expenses, of course, when you need to start investing and saving and managing your expenses. So there, I think, start with the basics, and you have to know exactly what's coming in and what's going out. And there's absolutely, I think, an ideal, but the ideal will look different through different life phases. And I think also knowing that for someone who's starting to work compared to having young kids and maybe nearing retirement or being in retirement. And I think understanding where you fit in and how you plan is important.
Yeah. If we focus on protect, I think the one thing that's interesting is everybody says you need life cover, but nobody tells you how to understand what the life cover should cover. So how much life cover should we think about? What should it actually cover?
This is such a powerful tool, and I think understanding life cover and where it can fit in, not only is it a form of wealth creation, it could be seen as that, but I think the basic needs are normally that you would like to protect your family, of course. Yeah. So you would like to cover debt should you pass away. And after that, only you would start replacing your income in the household. And that can look different to everyone. And this is, of course, also a moving target. Maybe younger in your life where you don't have a large investment portfolio, you would require more cover to take care of your family, and you maybe have minor children. Where later in life, you might not need this cover at all anymore, unless if it's there to plan for estate duty or fulfill certain needs. So this would also be a changing figure through different phases of life.
Yeah. And if you think about when you are advising your clients, is there a common misconception or like a blind spot that people have towards insurance or, for instance, something like medical aid?
Absolutely. I think in principle, this is, of course, something you hope will never happen or never be needed. And I think that's where there's sometimes almost a mindset that this will never happen to me or my family. So it's not an easy topic to discuss, but it's also then something that's normally not covered for, especially when it comes to something like income protection or medical aid cover. This is something we all need, and yes, hopefully we'll never use, but if you don't have it, that's your biggest asset, is yourself and your ability to earn an income, and that needs to be protected.
100%. If we look at the grow section, this is the only part of the entire financial wellness checklist that actually allows you to increase your budget, right? So we're going to spend a bit of time here. If we are starting our financial journey, Elke, where would you say our money should go? Where do you start first in an investment journey?
Starting off is always actually the most fun place to be, because you have a clean canvas and you can start building your future. And it starts small. It doesn't have to always that you be a scenario where you start with everything at once, and especially if the budget doesn't allow. But there are definitely a few pillars which I would recommend, if affordable, you start addressing from day one. The first would be, of course, having some form of an emergency fund, a form of accessibility in your portfolio. I think that's incredibly important. Secondly, starting with retirement planning, and that would either be your retirement fund at work or a retirement annuity in your private capacity, or a combination. And this is not only for retirement planning, but it's for tax benefits from day one as well. And then I think optimizing all your individual tax benefits you're allowed to have, and that's where tax-free investment fits in as well. So definitely the 3 different pillars I would focus on from day one.
From day one. And if we talk about retirement, how much is enough? I mean, I know it's a commonly asked question, but it's probably, the $1 million question.
And a very important one, because I think there's the general rule of thumb where you need to save 15% from the day that you start working to be able to replace your income one day. But I think the 15% figure sometimes gets a bit stuck in everyone's mind, where this figure might look different through different life phases. If you only start saving 5 or 10 years later, it might not be 15% for you anymore. So knowing that replacement ratio and also planning the taxation element of it with it. A lot of investors tend to forget the tax element after retirement, where if you have a combination of portfolios in your investment portfolio and you optimize taxation, you might need to have less provision because you're optimizing it better from a taxation perspective as well.
And if we think about, you spoke about risk as well. If we think about risk, what is risk in an investing context, right? Because let's get that definition there first. And then, is there such a thing as taking too little risk?
Absolutely. And I think risk is something that needs to be defined very well. I think the moment you have volatility in a portfolio and you have equity exposure, investors think that means risks. Where that is not necessarily risk if it's just markets moving and having volatility, where I see just being invested in cash as more risk because you're not actually keeping up with inflation. So that's the main goal we have when it comes to building wealth, is that you need to keep up with inflation. And that's where you need growth assets. So taking too little risk, if we can define it like that, or having growth assets in your portfolio is actually more detrimental to your portfolio. If you think of what actual inflation in your portfolio would be, and there I normally compare, let's say, what your medical aid goes up with every year, which is an 8 to 9% increase. Your buying power needs to keep up with that. So you need these assets in your portfolio. And I think just understanding where they fit in and combining them with more conservative allocations as well. So for shorter term needs, we can allocate to cash and bonds and more consistently performing asset classes. But the growth assets are almost the most important part in your portfolio.
In your portfolio. So you've mentioned two opportunities there. You've mentioned, for instance, having too little risk, so too conservative, and then you also mentioned for longer term needs, you may need a little bit more. Can you outline a few more investment scenarios where you may need a little bit more risk, and a few investment scenarios where you actually should maybe be taking a little bit more risk? And in risk, you said equities, for instance.
I think it depends on the individual needs of the portfolio and what you need it for. Let's say, for example, you have a shorter term need and you want to use this portfolio a year from now to put down a deposit on a house, for example. Yes, then we need to invest more conservatively. If you are retired and you're drawing an income from your portfolio, certain aspects of this portfolio would be invested more conservatively where you're living off of. But anything over and above that, you can easily combine growth assets. And that's a combination of local and offshore equity exposure. And the balance of that gets changed as the world changes. So it might not always look the same. Even if you were to retire today, and I think that's an important mindset to have, we're still working with another 30-year term. So the investment term is very long. So don't be too hesitant of adding in equity exposure, and how you do that with maybe an active approach and a very well diversified approach, it's not something to be scared of.
You actually have to have some equities if you're investing for that long.
It's the only asset class that really outperforms inflation. And I think that's important to understand, especially through different market cycles. If we are in a cycle where interest rates are lower, the returns you're getting on cash or cash in the bank even is just simply too low. You're essentially losing buying power on a daily basis. And I think that's something that needs to be understood.
The risk of not taking too much risk.
Yes.
Absolutely. And so if we chat about, you mentioned retirement annuities and you mentioned tax efficiency earlier as well. Chat us through different investment products and where you'll use it for things like accessibility, where you need maybe liquidity, and obviously tax efficiency as well.
Yeah. So there are a few wonderful products from an investment point of view that I think each individual needs to optimize, where the first is a tax-free investment. I think each individual and each child needs to have one, where essentially, as the name says, you can eventually, when you cash out this investment, there will be no tax payable on it. So this is a given. You're allowed to do 46,000 rands a year, and this I would recommend to every individual. Together with that, there would be the retirement fund component, and again, this is something you can deduct from it's a deductible for tax, so it's a great benefit. And it's also an excellent estate planning tool, as everything you invest in a retirement fund is completely stripped from your estate, so your loved ones will receive it immediately. This can be a retirement fund at work or a retirement annuity in your private capacity. You can also have both. So up into 27.5% of your taxable income every year, to a maximum of 430,000 rands a year, you can invest in this product and claim it back from your annual tax. So there's an excellent tax benefit in using this product, and all growth that takes place inside of the investment is also tax-free. For short-term liquidity, I would, depending on what the real needs are, but let's say for an emergency fund, I would always recommend a voluntary investment. Yes, I think there's a place to have X amount in your bank account for something you might need today.
Yeah.
But anything you would need 3 or 4 days from now, I would always recommend rather investing it. It's safer, it can be more diversified, and you can still access this within a week if you need it for an emergency.
So for emergency fund, accessibility is most important. For the longer term investing, the tax efficiency is something to be quite considered. And then offshore investing?
Definitely important, and there are 2 ways to do this. So in all of the investments we just spoke about, you can do offshore investing, but this will most probably be rand-based. So that's when we typically use what we call feeder funds. So you do have offshore exposure, but it's on a local basis, so it's still in rands, where a great opportunity within your portfolio is to start moving funds directly offshore, where you have an annual allowed limit you're allowed to move out of the country. And this would be physically moving out of the jurisdiction. It's out of South Africa, and you can start optimizing it there. Here, the structure becomes very important because, of course, in other jurisdictions, other tax rules and other estate implications start playing a role. But it's a wonderful way of diversifying, not just away from the rand, but also gaining loads more investment opportunities, because the moment you're working with dollar or you're working with pounds, you get to invest in other stocks and other fund managers that are available on the table.
100%. And if we look at legacy, so I mean, some people think, it's far into the future, I don't need to think about it today. But essentially, we're thinking about legacy as protecting what we've already built, right? So what's the risk of not having a valid and up-to-date will for us?
Not only the will that we unfortunately see quite often, that people just don't have it in place. And I know it's because it's an uncomfortable situation, an uncomfortable discussion, but it's something you need to do once. But together with that, of course, also addressing your entire investment portfolio. So any investment you have that doesn't allow a beneficiary nomination, so even if it's a fairly large share portfolio or cash you hold, this will go to your estate. And then it goes according to the will. So if you don't have one in place, it means you die intestate. So in South Africa, this will most probably never land with your family as planned. So the combination of a signed and correctly signed will, I think legally that's also important to know that there's witnesses, everything that's required, together with optimizing certain investment products where you can plan for beneficiary nominations, I think is imperative. I think we unfortunately see so often that wealth has been created in brilliant ways, but it will most probably not go to your family should something happen, or it will take very long. Unfortunately, the process in South Africa of winding up an estate takes very long because of inefficiencies at the master's office. And this unfortunately can take at least a year or more. I've had so many clients where up to 7-8 years of struggling to wind up an estate. So if your family requires some of this funding and knowing that they can't really reach it, that to me is important to ensure your planning is done correctly.
So how do you make sure that there is liquidity in a portfolio for your family once you've
various
passed?
ways, and I think that's important to do the whole concept of an estate analysis or planning, because it depends on your portfolio. So there are ways of planning for liquidity, and this can be done with life cover. It can also be done with certain investment products by ensuring cash will be readily available for the family immediately. Even if there are certain assets that still need to go to your estate, like a property or whatever it might be, at least you know there is immediate cash available. And this can even be a combination of investment products and life cover should it be needed to also plan for estate duty. Remember that there will always be some tax component payable, and you can plan for that in various ways.
And of course, if you have a beneficiary nomination and it's actually completed, you won't have to pay executors' fees, which also helps a little bit.
Exactly.
What would you say is your biggest takeaway, or rather the best advice that you can give somebody? Of course, this is a very difficult time in somebody's life. What's the best advice that you can give to make sure that it's less difficult?
Yeah, I think that's what makes it so difficult, because it is an emotional time when anything happens in a family, and it's not necessarily only death, but maybe say illness or divorce or whatever can happen here. And I think making sure in good times that your planning is done correctly. It's something that essentially you only have to do once or twice in your life. And yes, as things change, as let's say you don't have minor children anymore, or you have minor children now, that your planning needs to change. So I think that's important, knowing all your structures are set up. And I think ensuring that there is an independent team that takes care of it, because that's exactly what you don't want to deal with. So when it comes to, as an example, being the executor on a portfolio, I don't know if you want to deal with it at that stage when something happens to a family member close by. Yes, you can be involved, but I do think you want someone who will take action in the decisions that need to be made. And that's why I think just having an advisor and a team of advisors, most probably, that you will feel comfortable with at that stage in life.
100%. Thank you, Elke. The Know, Protect, Grow and Legacy checklist gives you a way to start to self-assess, but it's not exhaustive. A checklist raises questions and creates awareness, but it doesn't provide you with the answers. And that's where a financial advisor comes in. A well-constructed, personalized financial plan should include everything we've spoken about on the checklist, including budgets, investing, insurance, and legacy. That will help you reach your own investment and life goals and stay committed. But most importantly, a good financial advisor will also provide you with a sense of security and peace of mind. Now that you know your numbers, your next move is to choose which one of the breakaway sessions are most relevant to you. A discussion about marriage, retirement, next-gen investing, or educating and leaving a legacy for your children. Thank you.